Welcome to Chapter 7. This is our first Virtual Accounting 101 class for spring semester 2020. You should have played and watched the fraud PowerPoint provided in this week's module. This PowerPoint will continue that discussion with Chapter 7. Chapter 7 begins with internal control examples. Internal controls provide safeguarding procedures for assets. Businesses and organizations deal with employee theft, robbery, and unauthorized use of assets. These are considered illegal acts, where the perpetrators can actually be arrested. In addition to minimizing illegal acts, internal controls enhance the accuracy and reliability of the accounting records. These inaccuracies are caused by human error. In this safe, you can see an illustration of each of the principles of internal control. Your chapter provides more detail of each of these, beginning on page 320. The first one, establishment of responsibility, states that control of assets is most effective when only one person is responsible for a given task. For example, a cashier should sign in and use only one cash register throughout the day. Therefore, if cash is missing when the amount of cash collected is compared to the amount of sales, that employee could be identified and held responsible. The next principle is segregation of duties. This one states that different individuals should be responsible for related activities. Be sure to read this section in your book so that you don't confuse establishment of responsibility and segregation of duties. Pause the PowerPoint to take a moment and read the question and then select an answer. This slide presents a good illustration of segregation of duties. When one employee performs related duties such as collecting cash and maintaining the cash balance in the books, there can be an opportunity for fraud or other illegal activity. Pause the PowerPoint to read the question and select an answer. Having effective internal control procedures in place is important, but the documentation that these procedures have been followed is just as important. Other human resource controls are the bonding of employees who handle cash. Bonding involves obtaining an insurance policy against theft by your employees. The other, rotating employees' duties and requiring employees to take vacations, help to deter theft as the employee cannot be there to conceal their improper actions. Even though you may have segregation of duties controls, an organization should include independent verification. In this illustration, we have one employee who maintains the cash balance, another maintains the custody of the actual cash, and the third individual provides that independent internal verification by comparing monthly reports and examining the differences between the cash and the amount per books. Using the example narrative and Excel spreadsheet in your module, follow the next few slides to complete the reconciliation for the Portland Boat Company. As you can see from the previous slide and this slide, the bank balance does not agree to the cash balance, so the bank account requires a bank reconciliation. If the bank reconciliation items or the differences between the bank and the company are related to time lags, there is no need to make a journal entry. Some reconciling items do require journal entry. Please see reconciling items 3, 4, 5, and 6. A journal entry is prepared in order to be sure to reconcile your cash account to the bank balance. The last section of our Chapter 7 is petty cash. Please see page 331 and pages 347 through 348. This is the Appendix 7A. Be sure to read these pages. The red box is a typical example of the petty cash box used in an administrative office. Companies and organizations don't always use purchase orders and checks to pay expenditures. Sometimes a purchase can be so small and insignificant, it's easier to pay cash. As the book describes, some of these small amounts are for postage, maybe for employee working lunches or meetings, or small transportation or parking fees. When a business begins operations and decides to establish a petty cash box, the journal entry that is made is a debit to petty cash and a credit to the cash or checking account as illustrated in this first journal entry. The second journal entry shows that when the custodian of the petty cash box decides more cash is needed to replenish the cash in the box, in this case, expenses were made during the month for postage, meetings, and office supplies, so that the amount of $50 is what is needed to replenish the cash by going to the bank and getting cash, paper cash and change. When a petty cash fund is established, typically it will always be shown on the books at the initial amount, in this case $100. This completes the topics for Chapter 7. Be sure to read the chapter and contact me, your instructor, if you want to discuss further or if you have any questions. Complete the Chapter 7 homework and also complete quiz number 5, which you can find in the assignments in our module.